very good evening, ladies and gentlemen. Thank you for joining us for tonight's Corporate Connect webinar, jointly organized by SIAS and supported by SGX. This evening, we have with us Mr. Geoff Howie, Market Strategist of SGX, who will be sharing market updates, followed by United Overseas Bank's presentation and Q&A session. Without further ado, let's welcome our first speaker, Mr. Geoff Howie from SGX. Mr. Howie, the floor is yours.
Thank you. Just give me a second while I show myself. Nope. I'll stop the share and I'll just get back and start my video, and now I'll restart the share. So apologies for this, but good evening to everybody. My name is Geoff Howie. I'm the SGX Market Strategist and intend to provide a very quick overview for the next 15 to 20 minutes on the current market drivers of our Singapore stock market. Must point out, of course, that this is predominantly an informative session, and all the recent observations are really focused on our stock market and is in no way providing any investment advice. So straight to it, and the STI's, I guess the first test of 2021 was breaking that key psychological level, the 3,000 level that we discussed last time at the SIAS Corporate Connect event. And it was first tested in mid-January before closing above that key level on the 4th of March. Its next test has been the 3,200 level. It closed at 3,207.63 today. And you can see this black line on this chart represents that 3,200 level, which has provided some, I guess, limited level of support or resistance on and off over the past 3 years. In the 2021 year to date, the STI has generated a 12.8% price gain, and dividends have boosted that total return to 13.2%. The first quarter of 2021 was the STI's strongest first quarter for a calendar year since 2012. And among 18 of the big global stock benchmarks that include the regional, many of the regional as well as some of the international, the STI has been the second best performer in the 2021 year to date, second to the Taiwan Stock Exchange Weighted Index, which has generated a 13.5% price gain in Sing dollar terms. And the third best performer was the S&P Toronto Stock Exchange, third place with 12.3% price gains. So it's interesting because that's three different factors or sector drivers driving those three outpacing indices. For the STI, it's been our banks. For the Taiwan Stock Exchange Weighted Index, the TAIEX, it's been semiconductors. And for the Toronto Stock Exchange, it's been commodity prices. So from the current levels of 3,200, the STI would have to rally another 2% to the pre-COVID-19 high, which was near that 3,280 level back on the 17th of January in 2020. And to reach its May 2018 high of 3640, the STI would have to rally another 13% from here. And for the STI to return back to that October 30 low of 2420, it would have to decline some 25%. We saw investors really significantly build their STI exposure in 2020. The combined asset under management of both the SPDR STI ETF and the Nikko AM STI ETF ended March 2021 at 2.3 billion Sing dollars. And that compared to around 2.2 billion Sing dollars at the end of February, but moreover, compared to 1.1 billion Sing dollars at the end of March 2020. So unit creations and redemptions generated $690 million of net inflows in those two ETFs over the last 12 months. And likewise, the current 30 STI constituents were recipient to 7.5 billion Singapore dollars of net retail inflows for 2020. And they've seen net retail outflows of 1.3 billion so far in 2021, with those flows ranging from 756 million of net retail inflows outflows, I should say. Just to repeat that, the 1.3 billion of net retail outflows so far this year have ranged from 756 million of net retail outflows for DBS to $117 million for net retail inflows to Mapletree Industrial Trust. Now, Yangzijiang Shipbuilding Holdings has been among the 3 strongest performing STI stocks so far this year, with around a 33% total return. And that share price has moved from 95 cents at the end of last year to, I think it closed at $1.26 today, with the recent high of $1.32 representing an 87-week high. The stock has been trading around $47 million of average daily turnover this year. So that's up 50%, more than 50% from its 2020 trading levels. And since the end of November, the share price of Yangzijiang, that 40% gain has coincided with a 32% increase in the price of Brent crude oil. And it has also been this stock among the top 5 performing APAC and top 10 performing shipbuilders across the world in the 2021 year to date. Now, Jardine Strategic Holdings has also been among the STI's 3 strongest stocks in the year to date. Both Jardine Strategic Holdings and CapitaLand have announced significant strategic restructures in the first quarter of this year. And it was back prior to the 8th of March open, Jardine Strategic Holdings announced that it had agreed to Jardine Matheson Holdings Company's proposal to acquire the 15% of Jardine Strategic Holdings share capital that it did not already own. Now, the trading activity in the stock, it surged in those subsequent sessions. Jardine Strategic ranked a top 40 stock by turnover in the 2021 year through to that announcement. Okay, and then from that announcement, from the March 8th onwards, it now ranks as one of Singapore's top 5 traded stocks for the year to date. Now, despite the US $33 cash offer per share being priced 40% above the VWAP closing price of, I think it was 23.53 cents over a 6-month period through to the 5th of March, there was some immediate market expectation that the offer might have been increased. And that saw the VWAP of Jardine Strategic Holdings as high as $33.51 between the 8th of March and the 31st of March, before the share price ended that first quarter at $33.02 in US terms. Now, that gradual convergence to the offer price, it did coincide, I think it was Business Times back on the 29th of March that said the company did not, they spoke to the company and the company said it did not intend to offer to raise the offer price. But what we did see, between the 8th of March and 31st of March, the combined net institutional and net retail outflows for Jardine Strategic Holdings, it totaled over 210 million Sing dollars. And liquidity providers and market makers had to provide the difference with $210 million of net buying, if you will. So unlike Jardine Matheson Holdings, which has added exposure to Jardine Motors and Jardine Pacific, Jardine Strategic Holdings, its revenue exposures, they are all replicable through the other public listings of the group. So I should say the Jardine Strategic is currently scheduled for deletion in the STI, effective the 13th of April. Should Matheson's cash acquisition of Jardine Strategic be approved on the April 12 special general meeting. And that means the stock with the largest market capitalization in the STI reserve list will join the STI, scheduled effectively the 13th of April. Currently, the stock of the STI reserve list that does have the highest market capitalization is Frasers Logistics and Commercial Trust. And as we also saw, we should mention also CapitaLand is seeking to list the more capital efficient investment management business and privatize that more capital intensive development business. And that's in line with the CapitaLand 3.0 objectives. And the stock did finish the first quarter as one of 11 stocks with double-digit gains in the STI. Now, it's poised to create shareholder value because APAC-listed real estate managers do trade on average at valuation multiples that are higher than real estate developers, okay? On the real estate developer sector overall, we did see on the 1st of April, the Urban Redevelopment Authority's first quarter private residential property price index its flash estimate, which I think is really the first 2 months of the year, that gained 2.9%. That was up significantly and up from 2.1% quarter-on-quarter gains in the fourth quarter of 2020. Now, our Singapore-listed real estate developers and operators, they were also amongst the strongest segments of Singapore stock market ahead of that quarterly report. If you look over the past 11 sessions or so, our iEdge SG Real Estate Developers and Operators Index generated a close to 7% return from the 18th of March to the 5th of April close, and that outpaced the STI's 2% return over the 11 sessions. So over those 11 sessions, we had companies like OKH Global rise, I think, around 24%. Capital Land was up 15%. Chip Hang Seng was up 9%. City Developments and Gwalker Land were both up 8%, and Propnex was up 7%. They led the index. Capital Land and City Developments have also been among the 3 strongest STI stocks over the 11 sessions. And City Developments has also been recipient to the highest net institutional flows of all the SGX listed stocks since the 18th of March. Okay. Now, while the 2021 year to the 1st of April STI gains have been led by the banks, as I'll soon discuss, if you look at the median price to book ratio of the 30 STI stocks, they are currently edging, they've edged around 11% higher from the end of 2020 through to around 1.3 times now. But the gains of the iEdge SG Real Estate Developers and Operators Index we've seen over the past 2 weeks has generally had much less impact in this price to book ratio. I think that the overall index is up around 7% this year, but the median PB ratio of the 22 constituents remains at 0.5 times. Now, for the region, quickly, before we go to the next slide, the steepening of the US yield curve, it has coincided with the US dollar trade weighted index gaining some 4% in the first quarter of the year. Thus, the majority of Asian countries that report equity flows did see outflows over the first quarter. Now, Singapore stocks, they make up 25% of our FTSE ASEAN All-Share Index, and the recent moves in global equities, they've all, as we know, they've been driven by expansionary monetary policy, vaccine deployment, expectations of sequential, I guess, economic and earning recoveries this year. And the Federal Reserve balance sheet has also now grown to $7.7 trillion. And I think the ECB balance sheet still stands a little bit above 7 trillion euros. This policy stimulus has helped support businesses in all shapes and sizes, and by extension, helped to fuel the moves in the stocks, the global indices, and of course, commodity prices. The big key driver since the turn of the year is that as of the 4th of April, we've had 665 million COVID-19 vaccination doses administered across the globe. That's 5 times now the total recorded COVID-19 cases, which is around 131 million. Now, looking a little bit more into the flows, as we said, the majority of Asian countries that report equity flows have seen outflows over the first quarter of 2021. However, sector exposure, it really has remained the dominant driver of the stock market. Singapore's financial services, its consumer cyclicals, and the healthcare sectors have all recorded net institutional inflows over the first quarter of 2021. Meanwhile, our traditional defensives, such as REITs, telecommunications, and consumer non-cyclicals, have recorded the most net institutional outflows over the period, over the quarter. Overall, Singapore stocks have seen net institutional outflows of 127 million in the 2021 year to the 5th of April. So that's congruent with the rest of Asia, with those outflows. But if we didn't have the net institutional outflows from Jardine Strategic Holdings, with institutional holders selling above the offer price in the month of March, then we quite possibly would have had more net institutional inflows for the first quarter rather than outflows. But nonetheless, if you look at retail outflows as well, it's been $1.2 billion. And so we've had net institutional outflows, net retail outflows, and market makers and liquidity providers making up the balance in inflows. The 10 stocks that have seen the highest net institutional inflows, they include DBS, OCBC Bank, UOB, who is with us tonight, followed by Yangtze Shipbuilding, Semcorp Marine, SBH Holdings, SATS, Fuyu Corporation, and Wilmar International. Interesting that proportionate to current market capitalisation, it's Fuyu Corporation that recorded the largest net institutional inflows of all stocks listed on SGX in the 2021 year to date. That stock has now recovered more than 60% from its 18.9 low, which was amidst the March 2020 volatility. And on 23rd of Feb, the company, which is really a vertically integrated manufacturer of these precision plastic components, it reported that its full year 20 results, net profit was up 33%, I think to around 17 million Sing dollars. And with the results, the company noted it will ensure its business resilience going forward and stability in the current challenging environment. And the company will continue to optimize operations, maintain its diversified customer base, and sustain a sound financial position. Pretty standard outlook for the company in amidst of the challenges that we have ahead in the year 2021. I should also mention that Thai Beverage, Jardine Strategic Holdings, Ascendus REITs, Mapletree Industrial Trust, ST Engineering, Keppel Corp, Mapletree Logistics Trust, Sheng Siong Group, and Venture Corporation saw the largest net institutional outflows, and sectoral rotation out of last year's, I guess, comparatively better performing REITs and manufacturers has clearly had a role in those flows. So onto the banks, and the key driver for the STI's performance this year, it's the simple fact that banks have made up the strongest sector across the globe in the first quarter of 2021. And that is the very same sector that makes up around 40% of the STI through DBS, OCBC, and UOB. And the day-to-day moves of global bank indices have been around 95% correlated with the prices of DBS, OCBC, and UOB for the 2020 year. If you look at the median gain of the top quartile of globally listed banks, it was 14.9% over the first 3 months of this year, coinciding with, of course, as we mentioned, those US 2-year and 10-year note yield curve, basically doubling from 80 basis points at the end of 2020 to near 160 basis points at the end of March. Now, the trio of DBS, OCBC, and UOB, as we said, it moved in tandem with their global peers. So as you said, the top quartile of global banks in the first quarter gained 14.9% or 15%. The average gain for DBS, OCBC, and UOB was 15.4% or also 15%. At the same time, our three banks were recipient to a total of $1.02 billion of net institutional inflows over the first quarter, which followed on from the trio averaging, I think, it was 21% gains in the fourth quarter of last year on $1.6 billion of net institutional inflows. And you can see the correlation here in this bar chart I've got on the top here. You can see we've got the most recent period on the far right, 31st December 2020 to 5th of April. You can see the Singapore banks, they've averaged 16% gains. The global peers, the top quartile global banks up 14%. And very similar returns from the 6th of November through the 31st December, 30th of October, a little bit of outperformance in Singapore, and then also a little bit outperformance here. So all in all, we have, I guess, seen a little bit of outperformance especially in the 31st December 2020 to the 5th of April, but maybe that's making up for a little bit of underperformance the previous period and outperformance in the period before. But nonetheless, look, the three banks have now consistently together reported more than $5 billion in combined quarterly net interest income for the past 3 years. They also, I guess, with their FY20 reports, as our companies do, detailed their plans for the year ahead. And among the three banks, some of the outlooks included, I guess, a more increased emphasis on digitalization. And I remember UOB specifically making reference to its omni-channel development, which might be touched on. tonight. And then you've also got obviously the broadening of the wealth management services and a continued focus on supply chains as well as growth markets. The trio did end FY20 with an average ROE ratio of 8%, and that's above the 7% median for both the top global banks and Asia Pacific banks. And while the Singapore banks now currently average a 19% premium to their book value, their price to book ratios do remain well off that 40% premium observed back in April and May 2018. And for those PBs to be back at 1.4 again, much will depend on the economy, as you would know. And as you may recall, back in 2017, Singapore was amongst the world's strongest advanced economies that year. It was also home to one of the world's strongest performing stock markets that year, and hence those economic signs will obviously be evident if we do see some type of economic recovery, as we are expecting. Obviously, we declined 5.4% last year, and we do expect to grow between 4 and 6% this year. I should also mention, and a very important point is that the trio, they trimmed their FY20 dividends to 60% of the FY19 levels. That was to bolster ability to serve credit needs and to absorb potential shocks if need be. But nonetheless, DBS, OCBC and UOB, they also remained among the top 10 constituents of the FTSE Developed Asia Pacific ex-Japan Sustainable Yield Index. And Global Finance Magazine also ranked the 3 banks Asia's safest banks again for 2020. So aside, I guess, for the impact on the banks, the yield curve in the first quarter of this year, the steepening was a major differentiator when comparing the stock market's performance to the fourth quarter of 2020. As observed through much of 2020, COVID-19, it has had a similar impact on large cap stocks across the world, with the key distinguisher, obviously, the sector or the industry that the stock represents. And it means sector exposure through index weights was the dominant driver of the STI in the first quarter of 21, just as it was in 2020. I should also, I guess, wrap up now. We're try to wrap this up by 7:25, almost there. I guess the degree, as we said, the degree of which global growth will swing from that decline of 4% for the globe in 2020 to a gain of 5% in 2021. It really depends on that continued COVID-19 containment, the efficacy of the vaccine, and the ability to maintain secondary lines of defense and to continue rolling out this vaccine. As we said, we've now got globally administered vaccine doses, which are 5 times the amount of recorded COVID-19 cases. While returns have been mostly sector driven, we've seen more broader returns in the first quarter of this year. And that's obviously still supported by those extraordinary expansionary monetary policies across the world. Now, our most recent launched channel is Telegram, colloquially called SGX Invest. We encourage you to find us on the Telegram channel. It does provide a means to send you, usually once daily, information or insights, as well as keep you updated with these upcoming events, such as the one tonight. And if you do prefer once a week emails, then of course we have the SGX My Gateway report, which SIAS has been supporting since its foundation 9 years ago. I think we're almost up to 350,000 subscribers now. So very thankful for your support, SIAS, and for having us tonight with UOB. And I'm really looking forward to hearing the presentation as well. And I will stop the share and I will move on to Facebook to watch from there. Thank you so much. And if there's any questions, by all means, you know, don't hesitate to ever email me as well, and I can or email SIAS, so you can forward the email, and then I can reply and give you as much information as you might require. Okay, thank you, and good night.
Thank you, Mr. Howie, for the informative market updates. Next up, we're pleased to have with us tonight Mr. So Ita, Vice President, Investor Relations of UOB, who will share more on the company. Mr. So, the floor is yours.
Hi everyone, can you see my screen?
Yes, very clear.
All right, good evening everyone. Thank you for joining this evening's webinar. I'm Ita from UOB's Investor Relations team, and I'm delighted to have this opportunity to share with you the latest updates at UOB. For those who are not familiar with UOB, here's a quick overview of the bank. UOB was founded in 1935 in Singapore, and over the past 86 years, UOB has grown from strength to strength through organic growth and acquisitions. We have established a significant presence in the region with fully owned subsidiaries in Malaysia, Thailand, Indonesia, and Vietnam. Among Singapore banks, we have the most comprehensive regional franchise. It is our price distribution network, which we have taken decades to build, and something that could not be easily replicated. As a commercial bank, our balance sheet construct is simple, with lending activities being our key credit exposure, and they are comfortably funded by customer deposits. With our Common Equity Tier 1 at 14.7%, our capital position ranks highly in the region and is well above the Basel III requirements. As we all know, banking is a credit cycle business, and taking a long-term approach to banking is intrinsic to UOB. As an owner-operated bank, management's interest is aligned with shareholders' interests, as our CEO, Mr. Wee's family, is the bank's largest shareholder. During the recent pandemic, we had demonstrated how we stood by our customers, as well as our commitment as a long-term player. As the Chinese saying goes, 风雨同舟，同舟共济. And throughout the crisis, we have built up a huge reservoir of trust with our clients. We've been working closely with the government and regulators to offer liquidity relief to our customers to help protect the productive capacity of the economies. And importantly, with our strong balance sheet, robust capital, and liquidity positions, we have been riding through this crisis from a position of strength and looking to emerge with a stronger regional franchise. And this is also something that has been recognized by the rating agencies, as demonstrated by our AA ratings, one of the highest in the world. In Singapore, UOB is a familiar household name and the bank of choice for many Singaporeans. Singapore is our home market and accounts for over 50% of our group's profit. As a leading Singapore bank with our roots and strengths in commercial banking, we have developed capabilities for full banking services across key segments of consumer and corporate banking, as well as treasury and asset management. UOB enjoys a well-entrenched retail banking presence. We are a leading player in credit cards and mortgage, and a major mortgage lender for private residential home loans. In the wholesale banking space, we have been helping SMEs to grow and prosper since we were founded in 1930s. And over the years, we have not only remained as a steadfast trusted partner of these businesses, but we also cemented our leadership in the SME banking segment. UOB's well-established franchise in Singapore serves as a robust foundation for us to pursue our regional ambitions abroad. Our strong financial performance and regional reputation have received strong endorsements from numerous leading publications, trade organizations, and also the investment community. As you look at this chart, you can see that UOB has a rich history of more than 80 years. This chart shows UOB's growth story and demonstrates our strong track record of executing various acquisitions successfully. Banks are sensitive to economic cycles, but UOB has been able to generate profits even during down cycles, just like the one that we're going through today. You may ask, how do we do it? Number one, discipline. Number two, consistency in the execution of our strategies, whether during good times or bad times. And why are we able to do this? Our CEO, Mr. Wee Ee-cheong, is from the Wee family, who holds an 18% stake in UOB. And what does that mean? There's skin in the game. With him on the senior management team alongside other members with many years of banking experience, UOB takes a long-term view on growing the franchise focusing on quality, sustainable growth. Today, we have full ownership and control over our regional subsidiaries. This is critical in enabling the smooth integration of our operations. Our integrated banking platform also helps in effective risk management by ensuring that risks are measured consistently across our entire regional franchise. Moving on to talking about Southeast Asia's potential. Well, if you look at the macro environment today, it's pretty much uncertain as the world continues to grapple with the challenges arising from the pandemic. But we believe that these risks remain manageable in Southeast Asia, given that governments have responded to the pandemic swiftly in terms of lockdown and also roll out large-scale stimulus and extensive relief measures with the aim of returning the economy to a sense of normalcy as soon as practicable. Beyond these near-term headwinds, we believe in the immense long-term potential of Southeast Asia. Geographically, ASEAN's proximity to major markets such as China reinforces its strategic role in the global manufacturing and supply chains. ASEAN has also been the third largest FDI recipient globally, as each of the ASEAN countries have laid many years of groundwork in fostering ecosystems in specific industries. Economically, ASEAN's GDP had doubled over the last decade, and today it is the fifth largest economic bloc globally. Trade has grown steadily, and ASEAN is now the fourth largest trading group globally. Demographically, if you look at ASEAN's population, more than 650 million people, this is the third largest in the world just after China and India. Its young, driven, and enterprising population underpins ASEAN's workforce and consumer base in the coming years. The number of middle-class households is expected to increase, which will drive not only end-market domestic demand, but also intra-regional trade and investment flows. If you look at the individual countries within Southeast Asia, they're all pretty small, but the collective potential is tremendous. We continue to see opportunity from the realignment of global supply chains, and the current COVID pandemic has definitely accelerated these conversations between the trade-off of efficiency and resilience. This is likely to be boosted with the conclusion of the Regional Comprehensive Economic Partnership. Although having manufacturing and supply chains being concentrated in one location is great for efficiency and profits, but as we have seen from the current crisis, these have been disrupted by lockdowns. More and more companies today are looking to strengthen the resilience of their supply chain through gradual diversification into multiple locations. And Southeast Asia has been cited as a key beneficiary of this global supply chain realignment. For example, Vietnam is often cited as a key beneficiary for labor-intensive sectors such as furniture and textile manufacturing. Malaysia has been cited, given its developed ecosystems, to be having a niche in electronics and precision engineering. Now, UOB, as the bank with the most diverse regional franchise amongst our peers, together with our strong balance sheet and deep local knowledge, we believe we are well positioned to capture these opportunities around the region. In fact, many of our customers have already approached us to explore the shift of their manufacturing base. To expound on the region's potential, let's look at this chart on slide 8 that shows the banking penetration growth potential and population sizes in the region. Now, UOB today, we serve over 5 million retail customers, 2 million in Singapore and 3 million in the region. While we remain a dominant player in our home market of Singapore, we see vast untapped retail banking opportunity in the populous, underserved markets in Southeast Asia, the likes of Thailand, Indonesia, Vietnam. And this is the reason why we have prioritized the launch of Tomorrow, our mobile-only digital bank in markets with larger populations and high banking growth potential. In these markets, digitally savvy customers can be served with a simple banking app that meets their typical CASA, payments, and borrowing needs. And through Tomorrow, we're able to expand the base of our client franchise in the region. by acquiring customers digitally, which is a much more cost-efficient manner. In the region, expanding and scaling this client franchise is critical so as to feed the future growth of our franchise. By targeting the young professionals and their families in these large markets, we are in fact acquiring and cultivating the best customers of tomorrow. As they move up the wealth continuum, we seek to serve their increasingly more sophisticated wealth needs through the channel of choice on our omni-channel platforms, be it digital, face-to-face, at our branches. And in Singapore, where we have already a pretty much solid franchise and client base, we have seen that our omni-channel approach helps to meet the multifaceted, complex customer needs in order to be the primary bank of choice for our clients. And through our omni-channel platforms, we are able to better cross-sell and drive higher revenues while deepening the relationship with our clients. Now, moving on to talk about our growth drivers. While we remain entrenched in our home market in Singapore, the growth opportunities really lie in the region. The population base in Singapore is 5 million, but we are looking at a potential of banking a population base of more than 650 million people in Southeast Asia. And today, our regional operations outside Singapore contributes about 40% of the group's profits. We started our regionalization journey since the early 2000s. Back then, Singapore's small market had already become saturated. Businesses were looking abroad for opportunities, often in neighboring countries like Malaysia, Indonesia, Thailand. We followed our customers and expanded overseas. And today, our customers are supported by our fully owned subsidiaries abroad. You might want to note that UOB is the only Singapore bank with a Thai presence. We have also added a subsidiary in Vietnam recently in 2018, where we were operating under a branch license since 1995. Having operated in the region for 86 years, we have been facilitating connectivity and sustainable growth of businesses, whether they are big or small, across the region through our integrated and comprehensive network. And let me now share with you some of our more salient achievements. In wholesale banking, we have been focusing on enhancing our capabilities and diversifying across geographies, sectors, and products. Today, cross-border income accounts for 1.2 billion, or 29% of our group wholesale banking's income. We expect this figure to grow as COVID has accelerated the pace of supply chain diversification into Southeast Asia. The recent conclusion of the Regional Comprehensive Economic Partnership, the RCEP, we expect further deepening of the trade corridors between China and ASEAN, as well as amongst the ASEAN markets. UOB, like I've mentioned, is well positioned to ride on these emerging trends to capture the rising trade and investment flows, precisely because of our comprehensive regional network, and more importantly, the deep local knowledge in the region. Our sector-specific insights and solutions also help to synergize businesses and to mitigate risks across their value chains. Our financial institutions group have been able to capture the flows to this region as we deepen relationships with global funds, banks, and non-banks financial institutions to register a very commendable 17% growth. Similarly, our digital investments are showing results as we deliver greater convenience to our corporate clients by empowering them to make safe, seamless, and secure digital transactions. Over the years, the number of cashless payments to SMEs and corporates via our corporate PayNow in Singapore and digital banking transactions via our BIB Plus grew by 6 times and 23% respectively. Moving on to our retail banking business, we have started our digital transformation journey since 2016, investing in digital capabilities and transforming our physical footprint. Today, we are seeing the fruits of these investments. AUM rose 6% to a new high of 134 billion, even during the pandemic. Of these, about 60% were from overseas customers that are serviced through our group's network. Today, a higher 67% of our customers are digitally engaged. And at the heart of our customer engagement strategy is our omni-channel approach, where we complement our digital engagement with our RMs to best serve our customers' needs. Our internal study statistics show that our omni-channel customers are able to generate at least 50% more revenue than physical-only or digital-only customers. In Singapore, we're expanding our range of wealth management products and services on our UOB Mighty app. Recently, we launched a product called Simple Insure. It's a digital bank assurance product that requires just a simple health declaration. Our digital bank Tomorrow had also become a hit with young professionals and the families in the region, recording a threefold increase in customers across Thailand and Indonesia just in 2020 alone. 70% of Tomorrow's customers, new customers, are new to the group. As a digital bank, Tomorrow had enabled us to transcend the physical boundaries of our branch network, enabling us to acquire and onboard significant customers even amid a pandemic. Tomorrow customers now account for 26% of our retail base in Indonesia and 12% of our retail base in Thailand. And these are not only, impressive numbers. What's more important, at the same time, 25% of our Tomorrow customers are also highly active customers who transact at least 4 times a month with us. These are quality customers. And complementing our omni-channel approach is our ecosystem partnerships. We'll continue to widen and deepen our franchise with relevant ecosystem partners to provide holistic solutions for our customers. Moving on to sustainability. According to a study by Bain & Co., there's actually a $1 trillion opportunity in green and sustainable finance right here in Southeast Asia. In line with the UN 2030 Agenda for Sustainable Development, and as well as what we have locally, the Singapore Green Plan 2030, we are committed to play our role in the region's transition towards a sustainable and more climate resilient economy. We developed the UOB Sustainable City Solutions, comprising a comprehensive suite of customized financial solutions, leveraging on our bank's core strengths and ASEAN footprint, featuring cross-sector initiatives that are housed under 3 sustainable finance framework. We're happy to share that as at end 2020, our sustainable financing portfolio totaled more than $11 billion. In 2020 alone, we extended more than $4 billion of sustainable financing to clients of more than 4 times the amount in the previous years. We remain very optimistic of this sustainable financing opportunity in ASEAN, and we are currently working with a pipeline of 500 customers to help them transit into a more greener economy. To give an example of the tangible impact that we have made, our Youth Solar program, which is Asia's first solar industry ecosystem, it has facilitated the generation of 160 gigawatt hours of solar power across ASEAN. That reduces more than 77,200 tons of greenhouse gas emissions. To put it in simple terms, that is equivalent to almost 1.3 million new tree seedlings being grown over 10 years. We're also witnessing growing interest by our customers in responsible investments, and hence we have integrated ESG into our wealth management and investment offerings. As a responsible financial steward, sustainability has been deeply embedded across our strategy. The recognition by extra financial rating agencies and inclusion in the leading sustainability indices, as you can see on this slide, are a testament of the progress we have made on this front. Next, I'll give you an update on our latest financials. Our performance for the financial year 2020 really have reflected the adverse market conditions, right? Earnings declined 33% year-on-year to 2.9 billion. That is broadly in line with the industry. But nevertheless, it's important to note, we continue to maintain our profit-making streak. Margins were impacted by the plunge in the benchmark interest rates, as well as our shift towards lower yielding but higher quality assets in the first half of the year. However, our active liability management, flowing through with lower cost of funds, had actually led to a recovery and rebound in our net interest margin in the second half. We expect our net interest margin to stabilize around current levels, about 1.57%, as interest rates are likely to stay low in the near future. Fees were also affected, as you would have imagined. Wealth management, credit card business were weaker as a result of the widespread travel restrictions, lockdowns, social distancing measures. These have all limited customer interaction and disrupted retail spending in the first half of the year. Nevertheless, we actually witnessed a fee rebound in the second half of the year as the economy is gradually opened up and activities pick up. In fact, wealth management fees managed to grow 11% in a year where all economies actually slowed down. This is testament to our franchise resilience as customers continue to entrust us to help them grow their investments. As I mentioned earlier, our AUM actually registered a 6% increase year-on-year. Overall asset quality of our loan portfolio remained intact. If you look at NPL ratio, it stayed low at 1.6%, as the loan moratoriums and the various government relief measures supported low NPA emergence during this period. With the enduring impact of the pandemic on economies, UOB, we have set aside 900 million of additional allowance on non-impaired assets this year, even as our NPA formation stayed low. While this has affected short-term profitability, this, we believe, is a conservative move to strengthen our coverage and balance sheet to withstand any potential credit migration. Despite the challenging circumstances that we are facing, we are fortunate to have a very diversified core franchise, and that has helped us to provide stability. As you can see, the operating profit actually eased in Singapore. As a testament to the resilience of our Southeast Asian operations, operating profits in Southeast Asia outside Singapore actually grew 7% year-on-year. That compared to a decline of 21% in Singapore and 1% in North Asia, as economies of the smaller trade-dependent city-states like Singapore, Hong Kong, these were significantly impacted by the sharp decline in interest rates, as well as the sharp decline in business activities due to the economic lockdowns and travel restrictions. Through our disciplined credit policies over the years, we have built a well-diversified portfolio with prudent security coverage. To give you a sense of our loan book, geographically, more than half of our exposure is in Singapore. The rest is spread across several markets. There's no over-concentration. By customer segment, 51% of our loans are with large corporates, 15% SMEs, 34% to individual customers. All these are well diversified. While large corporate loans are lower yielding, but they also generate healthy risk-adjusted returns. Majority of our SME exposure is in Singapore and Malaysia, with 80% of our book being secured by tangible assets. If you look at industry sector, building and construction accounts for about a quarter of our loan book, total loan portfolio. This is an asset class which we are deeply familiar with. We have deep institutional knowledge and a strong management track record, given our conservative approach. Our consumer book is mainly in Singapore, in Malaysia, well secured with more than 80% in the form of housing loans. And we review our exposure to vulnerable sectors regularly, and we're comfortable with our portfolio mix and our security coverage. Throughout the year, you have seen that UOB had been very steadfast in the way we continue to support our customers across the region. We have provided various relief assistance programs in addition to government's relief measures. As loan moratoria around the region tapers off, more customers are now resuming their loan repayments. This has led to the loans under relief coming down to 18 billion, of which loans under government relief program falling to 1% of total loans. At UOB, we have dedicated restructuring task force that is proactively engaging our customers so that more comprehensive support could be provided where needed. More importantly, the more extensive coverage review from our restructuring task force showed a better than expected portfolio health. Vulnerable accounts that we identified actually amounted to only about 2 billion or 0.7% of our portfolio. We expect the total credit costs for 2021 to be significantly lower at 30 to 40 basis points, more towards the lower end. And our base assumption is, like I mentioned, towards the lower end of the range. As a truly long-term player, we strike a balance between focusing on the long-term earnings drivers and maintaining a strong balance sheet, as opposed to being short-term focused solely on earnings. Our balance sheet matrix, as you can see, continues to be healthy. On the asset front, you have seen in the previous slide that our customer loans remain very well diversified. On the liabilities front, our liquidity and funding remain sound, with customers' deposits being our primary source of funds. Given our position as an incumbent bank, coupled with good standards of corporate governance, rule of law, stable political environment in Singapore, we have benefited significantly from the increased deposit inflows, as you can see in the sizable increase in the CASA in this slide. In the region, our extensive network and our recently launched Tomorrow Digital Bank helps to ensure self-sufficiency in funding at our subsidiaries. Our CET1 ratio remains strong at 14.7% as of end of the year, and MAS have also reaffirmed the resilience of our local banks based on stress tests conducted under adverse scenarios. This is investors' favorite topic on dividends. With our strong capital position, our bank has the capacity to fulfill our earlier guidance of our 50% dividend payout ratio. More importantly, because of the long-term approach that's been taken by management, we have never missed a single dividend payment since our listing. But as you know, MAS has taken a prudent, preemptive stance on capital conservation. Earlier last year, they have called on local banks to cap our total dividend for 2020 at 60% of 2019's dividend per share. That works out to be 78 cents for the full year. As such, our board have declared a final dividend of 39 cents per ordinary share with an option for scrip dividend, but without discount because because of our strong capital position. We hope to resume that 50% dividend payout ratio subject to MAS relaxation of the dividend cap. In summary, we are focused on creating sustainable value across our franchise. We take a long-term view, looking beyond economic cycles when making investments in our people and our capabilities, so as to realize the potential of our regional growth drivers. As disruptive as they can be, crises come and go. We continue to monitor our asset quality closely with robust stress testing to anticipate the worst-case scenarios. We have proactive engagement with our customers, and that hopefully these will smoothen the impact post-moratorium period. Some of this credit migration is inevitable, but we have fortified our balance sheet and we expect to stay profitable and resilient. In the coming 12 to 18 months, macroeconomic conditions are likely to improve a bit gradually. ASEAN's connectivity with Greater China and the region's growing affluence continue to be drivers of growth. Our established network, deep sectorial insights, and our strong local expertise will ensure that UOB remain well positioned to help customers seize these growth opportunities. To ensure sustainable growth, we'll continue to sharpen our regional strategy while upholding our asset quality and maintaining cost discipline and efficiencies. With our net interest margin expected to stay low, we are rebalancing our business with an emphasis on wealth and connectivity-related products and services that will deliver greater value to our customers, and hopefully that will drive even higher fee income. This is in keeping with our omni-channel approach in serving customers as they shift towards using more digital banking solutions. We believe that we'll emerge stronger from this crisis and we can return to our pre-COVID-19 profit levels in the next few years, driven by top-line growth and lower credit costs. And in turn, we hope and we seek to deliver a better return on equity for our shareholders. Thank you for your support, and we'll be happy to take questions from the floor.
Thank you for sharing UOB's rich history and impressive achievements, Mr. So. In our last segment, we have a Q&A session. Should you have any questions, you may post them in the comment section below. Due to time constraints, we seek your understanding in that not all questions may be addressed. Without further ado, I would like to introduce our moderator for this evening, Head of Research from SIAS, Mr. Benjamin Goh. Hi, Ben.
Hi, thank you very much, Genevieve.
Sorry, Ben. Joining Mr. Goh tonight are lead panelist, Mr. So Ita, Vice President, Investor Relations, UOB. Mr. Stephen Lin, Head of Investor Relations, UOB. Mr. Alfred Chan, Senior Vice President, Investor Relations, UOB, and Ms. Yip Wan Leng, Vice President, Investor Relations, UOB. Over to you, Ben.
Thank you very much. So Ita, I just want to first say thank you very much for joining us. And it's always very helpful that people directly from the bank, come forward, and then we have quite a nice chit-chat session with the retail investors. As you know, retail investors, they're kind of shy, and they may or may not go to the AGM. So this is always a very good forum for them to, speak to senior management. We do already have a couple of questions that we have prepared, and I think there might be a few more coming through our Facebook page for the people who have, listened to your presentation live. And I'll just kick off with the first one. So your presentation spoke a lot about the initiatives, the wholesale, the whole of bank initiatives, as well as your Tomorrow app, so on and so forth. I think that one of the questions that the investors may have is that given what's happening with, the COVID-19, it's kind of receding into the back, vaccinations are happening and cases are going down. If we put aside the COVID-19 pandemic and you focus on the business part of the bank, what do you think are the biggest risk factors right now that UOB is facing?
Well, I guess the greatest risk is summarized in the word disruption, right? And I think there are three key sources of disruption which we can talk about tonight. First is on digital technological disruption. Secondly, geopolitical disruption. And finally, on climate change, climate disruption. Well, first on digital and technological disruption, we are witnessing the rise of fintechs, the rise of the entry of new digital banks that are coming into Singapore. You're seeing that the banking landscape in Singapore and the region are becoming ever more crowded and ever more competitive with more players entering the fray. I think this is good for innovation and it's good for as consumers benefit. At UOB, we take competition seriously and we take the threat of this digital disruption very seriously. Over the past 5 years, we invested over $2 billion in deepening our digital capabilities. We have refreshed our UOB Mighty app. If you look at it today, it has a brand new UI UX. There are new products, there are new capabilities. You can track your expenses. There are insight cuts, that advise you on your spending habits. On the wholesale side, we have also launched our UOB Infinity to serve our SME and corporate clients. We launched our digital bank Tomorrow, like I mentioned earlier, in Thailand and Indonesia. Well, we see this risk had also become an opportunity because during this pandemic, our Tomorrow Digital Bank in Thailand and Indonesia actually allows us to continue to acquire new customers in a very cost-efficient manner, and for us to continue to grow our franchise. Work did not stop despite the pandemic. And that allows us to transcend the traditional physical boundaries. And I think that is one positive opportunities that we have seized amidst this digital disruption. Second on geopolitical disruption, I think if you look at the dynamics between China and America, this geostrategic competition will definitely continue. And if you have looked at what happened over the past 3-4 years during Trump's presidency, you've seen what happened when elephants fight during the trade wars, right? And exposure to Greater China was, of course, the top concern back in those days, if you remember. But at the same time, this also surfaces a new opportunity. Building an anti-fragile, resilient sort of supply chain becomes very important. Diversification becomes very important. So amidst this geopolitical risk, we are seeing like I mentioned in my presentation, that there is growing need for supply chain diversification. Businesses are now adopting a China +1, China +2 type of model, where they are beefing up their supply chain resilience with additional manufacturing production sites. And for Southeast Asia is actually a prime beneficiary of this structural shift. For UOB, we are an ASEAN-focused bank. We have deep local knowledge, we have boots on the ground, with an extensive footprint, and we believe we are well positioned to capture these opportunities that arise from this disruption as well. And third is a hot topic, right? Climate change, climate disruption, and I guess climate change is the greatest challenge that mankind is facing today. And as for banks, the challenge is, how do we protect the bank's balance sheet from uncertainty, right? Uncertainty in the sense arising from the physical and transition risks that can potentially lead to value erosion, in the bank's value. But at the same time, we also see opportunities where the bank, like UOB, can help to finance a greener and more sustainable agenda. Now, as a responsible financial steward, like I've mentioned earlier, we're very happy to share that we have financed more than 11 billion of sustainable financing to date. We've also developed 3 of these sustainable financing frameworks, working with a pipeline of 500 customers to help them transit into a greener future. So in all these 3 disruptions, risks that I mentioned earlier, there are risks, there are threats, and there are challenges, but we also see them as valuable opportunities. And UOB, as you know, we always talk ourselves as a long-term player, and we stand ready to navigate these challenges and capture these opportunities.
Well, thanks for that. Very informative. And I think I want to kind of dive in a little bit more on one of the things that you mentioned just now, digital transformation as one of the possible disruptions. Because in Singapore, as you know, we've seen a couple of non-traditional financial or rather non-financial players being granted digital banking licenses. How does that new development impact UOB's strategy, vis-a-vis what you're doing with your Tomorrow app, as well as your whole of bank initiatives?
I think first, we believe it's going to be an uphill challenge for this new digital bank challenges, because as you know, Singapore is a very saturated market. You are facing not incumbents that are standing still, but we're all up in arms already.
So is
strengthen our digital capabilities.
So it's uphill for them, is it?
That's our belief. Maybe
Okay.
Let me share with you a couple of reasons why it's going to be challenging for them, right? First, I think the need to demonstrate a path to profitability against the backdrop of all these regulatory constraints. And now we're in a very ultra dovish rate environment. You can't dangle, it's very hard to dangle interest rates to make it attractive. So regulatory constraint is one thing that we should not underestimate, right? Previously, I was not from the banking sector, and you know, the number of people doing compliance in a corporate, you can count them with your hand, number of fingers on your hand. But you know, when I came to UOB, I look at, you know, how big the compliance department is. You can sense the difference. So we must never underestimate the cost of compliance at the bank, and for, you know, financial institutions with that fiduciary responsibility, you know, to our clients. Secondly, I think, like I said earlier, our incumbents are all up in arms already. You know, we are well positioned to compete with these new entrants. We have built up our digital capabilities. If you look at the 3 local banks, I think about 10 to 17% of our expenses are on digital, on IT. So for UOB, we are also not resting on our laurels. We have, I mentioned earlier, put in $2 billion in cumulative IT capex over the past 5 years. And we remain committed to continue enhancing our digital capabilities and transforming our branches, you know, to improve our customer experience, to improve productivity. I think the third point I want to highlight is that, you know, whatever new cutting edge innovation features that these new digital banks can come up with in the market, it's also something that the incumbents can easily replicate, right? Because you think about the amount of resources they have and we have, I think it's not something that will be unique to them. Over time, you know, there's no competitive edge that they can claim. Next, I think if you look at some of the research statistics that are available, you see that banking incumbents are much more highly trusted by both SMEs and consumers, especially during times of uncertainty. Remember, I mentioned at the start of my presentation, you know, we stood by our customers, especially our SME class customers. We extended, you know, liquidity relief support, and we stood by them. We did not cut our lines. And I think that has really built up a reservoir of trust. Our SME customers know that, you know, we're not the fly-by-night kind. We will continue to stand by them, you know, through good times, through bad times. We are here for them. And that is what UOB is all about, standing right by our customers. And the other thing there's an extension of this point is that, you know, for banks like UOB and our peers, we have been through credit cycles. We've seen through up and downs. But if you're talking about this new digital banks or fintechs, have they successfully weathered through a storm? I think that is probably something, you know, that future customers will need to consider. Now, if you look at the ease of account opening today, as well as all the, if you open up your phone and you look at the App Store or Play Store, you'll see that all our Singapore banks, our applications are actually very highly rated. And I think these are all a testimony of the consistent digital investments that we have put in over the years. So I mean, in summary, the high trust level that customers, Singaporeans have in the incumbents, to get coupled with the advanced, you know, digital offerings that we have today, plus the regulatory familiarity and advantage that we have, I think these are all, you know, the high barriers to entry, high barriers to competition. You know, like I said, it's going to be something very challenging and an uphill task for the new digital banks.
Well, I mean, just my 2 cents worth is that, you know, obviously UOB is a very trusted brand in Singapore, and I totally agree that it's going to be an uphill task in terms of client acquisition, as well as building a certain level of comfort with, you know, investors in Singapore. So, you know, the new players obviously will have their work cut out for them. All right, and I'm also very aware that you guys are not staying still. Every year at the FinTech Festival, you guys have a booth and you publicize your FinTech and your analytics lab and all that. So totally agree. So, but of course, I'm staying at the sideline, so I'll be quite interested to see how the fight develops. But my money is obviously on you guys.
Maybe, Benjamin, maybe I can add something if it's just to add on to what Ita has mentioned. So I think as what Ita highlighted, the Singapore market honestly is pretty saturated, but nonetheless, a lot of interest by all these new incumbents to get a license, which, you know, 4 of them have managed to do so. But I think the general market view is that most of them are using Singapore as a test bed for their regional ambitions. And that is why we have decided to prioritize the launch of our digital-only bank, which Ita covered in his presentation, called Tomorrow in Thailand and Indonesia, where banking penetration levels are much lower and absolute population size much larger. So we have already anticipated some of these intentions by some of these new competitors, and we do have a first mover advantage in launching the digital-only offering in some of the bigger markets in the region.
Actually, thanks for that, Stephen. I mean, that really puts Ita's presentation in in a very broad context. So I guess it really makes sense. The initiatives that you guys are pioneering regionally, and I also do agree that for the new players to just focus on a Singapore market is going to be really hard. A hard path to profitability because you need scale for that. So let's put that aside. We do have a couple of questions from the Facebook page, but in the interest of time, I'll just pick the more important one. Okay, so we have one from one of our viewer. So all of the 3 local banks, and I'm just reading this out to you, all the 3 local banks, including UOB, have claimed that they have the ability to pay dividend according to the original dividend guidelines. So in UOB's case, it's 50% dividend payout ratio. So the question is this, so once MAS lifts the restrictions on dividends, will UOB be returning the dividend that was withheld last year because of MAS restrictions? Will that dividend tranche be paid back to shareholders as a special dividend?
I think for us, it was very clear in my earlier presentation on our slide on dividend. We stand by our commitment to pay that 50% dividend payout ratio to our customers, to our shareholders. We believe there's a fair amount because as a long-term player, there are also other uses for capital. We need to continue to prioritize our investments in digital. We need to preserve capital to capture the growing opportunities amid this recovery from COVID. So I think we've got to take care of all our stakeholders, and of course we will definitely take note of shareholders' feedback in terms of this request.
Okay, but I guess as here research, my 2 cents worth is, well, dividend is one thing, but your share price has been up and up lately, so I think that's pretty good as well. Yeah. I mean, I personally have it's kind of nice addition to my portfolio. So
I mean, maybe just to add on to Ita's response on whether or not we'll return the excess capital in the form of special dividends. I think if you follow the UOB stance, and I think Ita emphasized during his presentation that we are a very conservative long-term player. Honestly, Mr. Wee himself, being the largest shareholder, he would be the primary beneficiary of a special dividend, right? But because he has a long-term view and takes a long-term perspective of the bank, I think we cannot be complacent. We are not entirely out of the COVID woods yet. So I think for the short term, at least for 2021, we will likely to continue to want to keep some excess buffer of capital, because I think just in case something were to happen down the road. So I think if you're a long-term investor of UOB, please be patient. I'm sure if you take a longer-term perspective, your total shareholder return, including of dividends, will be very effective.
Okay. Well, that said, I would kind of guess that as the government yields go up, interest rate goes up, your net interest margin will probably improve, and that's going to add to your bottom line. And this is probably a conversation that maybe 1 year from now we may have a special bonus special dividend. I don't know.
Yeah, I mean, we are obviously not averse to special dividend. If you look at the chart that Ita showed on our dividend history, you can see that 4 of the last 5 years, I think we've actually been paying special dividend. So yeah. So I think that's something that management always bears in mind to ensure that we are remain equitable to our investors as well.
That's great. Personally, I prefer higher stock prices. So anyway, so jokes aside, thank you for a friendly banter as well as spending time with us. We have definitely overrun the time, and I think there is probably 1 or 2 more questions from Facebook as well as some of the pre-submitted questions, but I don't think we've got time for that. So on behalf of SIAS, thank you very much for joining us in this Q&A session. Genevieve, over to you.
Thank you, Ben, and panelists from Investor Relations at UOB for joining us tonight and for your insightful sharing this evening. We have come to the end of this evening's session. It has been a pleasure to have you with us. In the event you missed any part of this evening's session, you may rewatch it on SIAS Facebook page. Do like our page and check out our website to get updates on our upcoming investor education programs and initiatives. Thank you and enjoy the rest of the evening. Good night.